We now move on to question number 12 of the CA Foundation Course Revision Test Paper of September 2025. This particular question is from partnership accounts and specifically on retirement. It gives us that there are three partners, P, Q, R, and these partners are sharing profits and losses in the ratio of their capital. So what is the ratio of their capital? 50, 75, 50. That is 2:3:2. P is retiring from the business and the conditions are laid down, that is on his retirement, exactly what and how much will he have to be paid back. So when we go through the problem, we find that over here they state that this retirement is to take place on the 1st of April 2025 and the partner retiring P. Now, for this purpose of retirement, we need to prepare the revaluation account, the capital account, the cash bank account and the balance sheet. Land and building will appear in the balance sheet asset side, plant and machinery, balance sheet asset side, stock of goods, balance sheet asset side, sundry debtors, balance sheet asset side, cash and bank balance, will be recording that in the cash bank account. To balance brought down 17,500. Capitals will be recorded in the capital account. By balance brought down for P, Q and R 50,000, 75,000 and 50,000. And sundry creditors will appear on the liability side of the balance sheet. Now, what are the conditions that are laid down? 1. Land and building will be appreciated by 20%. So land and building is 75,000. 20% appreciation will be 15,000. So this appreciation will go in the revaluation account because it is appreciating, it's a gain. Therefore, it will come to the credit of revaluation, 15,000. The next item that we have is plant and machinery is depreciated by 30%. What is the value of plant and machinery? 50,000. A depreciation of 30% means 15,000. Now, if it's a depreciation, it means it will be a loss. Therefore, revaluation will get a debit to plant and machinery, 15,000. The next, third, stock is to be valued at 25,000. What is the stock at present in the balance sheet? 30,000. So, there is a decrease in the value of stock from 30 to 25. So, that means our asset of 5,000 is being written off. What will it be? Therefore, it will be a loss. And therefore, it will come in the revaluation account on the debit side to stock of goods 5,000. The next fourth item, sundry creditors of 5,000 are to be written back. When we say creditors are to be written, creditors are the persons whom we owe money. And because we owe them money, it's a liability. Now our liability is going to reduce. And they say the liability will reduce by how much? 5,000. Therefore, sundry creditors get reduced by 5,000. It works out to 20. Now, what will it be? It will be a gain, and therefore, in the revaluation account, it will be recorded by sundry creditors 5,000. Then we come to the next item. Provision for doubtful debts is to be at 5%. Our debtors stand at 27,500. Provision at 5% works out to 1375. Now our debtors are reduced. So if it is a reduced, that means an asset is getting reduced. That will be a loss to us. Therefore, debit of revaluation to provision for doubtful debts 1375. Next, there is a joint life policy which the partners had taken and now they are surrendering. When you surrender a joint life policy, it is a gain that will come for the business, and therefore we are receiving it in cash 18,875. So this will be a gain for the business. Therefore, by cash bank, joint life policy, that is surrender value, 18,875. Next item that we come to is goodwill. Goodwill of the firm is to be taken at 35,000. Now mind you, P is going to get his share of goodwill. How are the partners sharing profits and losses? 2, 3, 2. That means total parts, how much? 7. What is P's share? 2. Therefore, 35,000 is the total goodwill divided by 7 into 2. So, it works out to 10,000. Now, fine. Now, it means that P is supposed to be given goodwill to the extent of 10,000. Correct? That's his share. But we are only raising goodwill and then writing it off. Now, when we are doing this, it means who's the parties who will contribute to this goodwill and how will it be written off? It will be written off in the gain ratio. The new partners, the partners who would remain in the business would share profits in the ratio 1:1 equally. When we calculate the gain ratio, we find Q will get a gain of 1 and R will get a gain of 3. Because their new ratio, half, minus the old ratio 3/7, that works out to 1. Same way for R, his new ratio half, old ratio 2/7, it works out to 3. Therefore, goodwill of 10,000, which is supposed to be given to P, 10,000, will be shared, will be contributed by Q and R in the gain ratio 1:3. So Q contributes 2,500, R contributes 7,500. Second effect of it, in the partner's capital debit side, Q and R get a debit for the goodwill amount of 2,500 for Q and 7,500 for R. Then we come to the next item. Total capital of the firm is to be the same as at the time of retirement. What was the total capital? The total capital was 1,75,000. It means that the capital of the firm after P's retirement will be 1,75,000. And they're saying this goodwill will be contributed by Q and R in their new ratio, which is equal. So it should be 87,500, 87,500. So what is done? The closing balances of Q and R will work out to 87,500 and R 87,500 because they are equal. So now what we are required to do? In order to settle this amount, we first close the revaluation account and we find that we are making a profit of 17,500, which gets distributed in the old profit sharing ratio, that is 2:3:2. We close the capital accounts. And when we close the capital accounts, we are closing P's capital first. P's capital 65,000. What is the condition that is laid down in the adjustment number 9? That we will be settling only 50% of it in cash and the remaining 50% will be making payment later. So when we close P's capital, total works out to 65,000. He's getting a cash payment 32,500, which will work out in the cash bank account by P's capital 32,500. The remaining 32,500 remains of P. This will be shown as a loan account in the balance sheet on the liability side. Mr. P's loan account 32,500. Now after having done that, we close Q and R's capital, and when we close Q and R's capital, we find that there is a deficiency of Q to the extent of 7,500 and R 40,000. Now what is the problem stated? The problem has stated that these individuals, that is the total capital of the firm is to be the same as before retirement. Individual capital is in their profit sharing ratio. And how are these partners to be contributing it? They are going to contribute it in cash. So the deficiency of Q will be contributed in cash 7,500, are 40,000. So this will work out in the cash bank account to Q's capital to R's capital. We close cash bank account, and when we close cash bank account, the balance of cash bank works out to 51,375. And there we get the balance sheet tally at 2,27,500.